Washington's slow-motion train wreck is picking up some serious speed this week, with JP Morgan, the biggest bank in the country, now calling for 8% interest rates in a 61-page shareholder letter. That's something we haven't seen in a generation. It could be catastrophic for the economy and for the banking system. Keep in mind, this letter came out before last week's bombshell stagflation numbers, so now it is even more likely. Now, last time we had 8% rates was late 80s, and beyond setting off the first Bush recession, they translated into 10% mortgages and 9% yields on the 10-year bond. 10% mortgages would choke off what's left of the housing market, already limping on fumes at 7%. It would be another nail in the coffin of young Americans shut out of the middle class. It would roughly raise their buying cost by another 50%, so that would bring it to close to $4,500 on the median house. But actually, those 9% 10-year yields are much more important. In short, anything over 5 on the 10-year could kick off a chain reaction that could implode commercial real estate and get us back to crashing the banking sector, along with a cascade of debt defaults from credit cards to car loans to, yes, mortgages. This is because the 10-year bond is the keystone cost of capital across the economy. It measures the cost of money controlling for the stage of the business cycle. So business cycles rarely last more than 10 years. So it's effectively the structural cost of borrowing. Problem is that if you suddenly hike that structural cost of borrowing, not only does it crush consumers, it crushes businesses as well, starting with interest rate sensitive industries like cars, housing, and of course, banks, along with the trillions in malinvestments. So those are businesses that only exist because of Fed-subsidized cheap money. They fail in a cluster. Now, we got a taste of it last year when a move in the 10-year from 2% to just 4% set off a domino of crashing banks that summed up to more than all the bank crashes of 2008. Those dominoes only stopped when the Fed and Janet Yellen effectively pre-bailed out the entire American banking system, using over $100 billion in loans written on fictitious values, along with a potentially $20 trillion expansion of the FDIC's bank account insurance, which would put the FDIC at roughly 200 times underfunded, which means that if they need more money, they would just take it directly out of your bank account. So that was 2 to 4%. Morgan is now calling for 8%. So what's next? Brought to you by Unchained.com. Hemingway once wrote, "How do you go bankrupt? Gradually and then suddenly." The funny thing about banking crises or fiscal crises is that they are gradual, then sudden. It all seems very abstract until one random Tuesday when it no longer is. So the day before Lehman crashed, for example, the U.S. banking system was astride the globe, and the day after they were on their knees for taxpayer trillions. At this point, everybody knows our fiscal position is unsustainable. Washington knows it, Wall Street knows it, but nobody wants to take one for the team to point out the emperor has no clothes. Instead, it's a giant game of musical chairs with Washington kicking the can for another year, another month, another day, and Wall Street playing along, hoping their lobbyists have spread enough cash donations to keep the bailouts coming. As for the rest of us, we get the fallout, the rising prices, the job losses, the trillions in debt. Okay, we'll be watching. See you next time.